Here we go, Mike Benoit, Part 2, Tyranny Busters, the sham and shame of the federal income tax. And to start off with, Otto Skinner's quote or questions. He goes, what is it that's actually being taxed? Is it people, is it property, or is it activity? There cannot be any intelligent conversation about a tax until the actual subject of the tax is known. Is it people, is it property, or is it activity? So we're going to pick up with Chapter 2 of my book, just what is income for tax purposes. And of course, again, we're going to rely on Supreme Court decisions. We're not going to rely on somebody's opinion. All right, so let's take a look at what the Supreme Court has stated about the definition of the word income. In Eisner versus Macumber, a case in 1920, it said, in order, therefore, that the clauses cited from Article 1 of the Constitution may have proper force and effect, save only as modified by the amendment, and that the latter also may have proper effects, it becomes essential to distinguish between what is and what is not income, as the term is there used, and to apply the definition or the distinction as cases arise, according to truth and substance. So, necessary to determine what is income. Now, we already determined that taxes on property or people would be a direct tax. And we already determined that income is okay to use as a measure of tax on a revenue taxable activity, franchise or privilege. So let's see what the definition of income is by the Supreme Court. It goes on to say, without regard to form, Congress cannot, by any definition it may adopt, conclude the matter, since it cannot, by legislation, alter the Constitution, from which alone it derives its power to legislate. And within those limitations alone, that power can be lawfully exercised. All right, so they go on, after examining dictionaries in common use, and they list the Bouvier Standard Dictionary, Webster's International Dictionary, Century Dictionary, we find little to add to the succinct definition adopted in two cases arising under the Corporation Tax Act of 1909. And it mentions the case name, Stratton Independence versus Halbert, and then Doyle versus Mitchell Brothers. The quote is, income may be defined as the gain from capital, from labor, or from both combined, provided it be understood to include profit gained through a sale or conversion of capital assets to which it was applied in the Doyle case. So that's worth repeating. Income may be defined as a gain derived from labor. Gain derived from labor. Now, I know a lot of folks think when they go out and they labor and they get $20 an hour for their labor, they think they got $20 gain, which is kind of a bizarre concept. Because it's to say, well, I really got over on my employer because he gave me $20 for my labor, and that's all gain to me, and my labor was worth nothing, and he gave me $20. If your labor was worth nothing, and you got $20 for it, then I would say that would be a gain. But this is the misunderstanding people have. Income may be defined as a gain derived from capital, derived from labor, or from both. The capital, if you had $10,000 in capital, you wouldn't consider that $10,000 in capital, if you got $11,000 return on it, you wouldn't consider the 11,000 as gain. You consider 1,000 of that as gain. So this is actually a tyranny upon the mind that's working in people's minds, that they've been conditioned to think that this income that they're getting from their labor, which if you look at this definition, it really isn't income. It's not gain. It's remuneration. They're getting this idea that that's income, and therefore that's this lawful measure of a tax on a lawful taxation, subject of taxation. So it's interesting to note that income is defined as the gain derived from capital, from labor, or both combined. Now, if you consider all you get from your labor to be gain, then you must value your labor at nothing. All right, so let's go on. Another quote here on the 16th Amendment, or let's say, maybe this is not the 16th Amendment. Let's take a look at it. In something in U.S. Supreme Court Merchants Loan and Trust Company. It says it's obvious that these decisions in principle rule the case at bar if the word income has the same meaning as the Income Tax Act of 1913 that it had in the Corporation Excise Tax Act of 1909, and that it has the same scope of meaning, was in effect decided in Southern Pacific Company versus Lowe, where it was assumed for the purpose of decision that there was no difference in its meaning as used in the Act of 1909 and in the Income Tax Act of 1913. There can be no doubt that the word must be given the same meaning and content in the Income Tax Acts of 1916 and 17 that it had in the Act of 1913. So, in other words, no matter how many acts parade on after, it still has to have the same meaning. There would seem to be no room to doubt that the word must be given the same meaning in all the Income Tax Acts of Congress. Next, in Doyle versus Mitchell Brothers, 1918 case, yet it is plain, we think, that the true intent and meaning of the Act, the entire proceeds of a mere conversion of capital assets, were not to be treated as income. So, if you don't take your capital and convert it into money, that's not considered income. Your capital, that's your labor, why would that be considered income? Whatever difficulty there may be about precise and scientific definition of income, it imports, as used here, something entirely distinct from capital, or from principal, or capital, either as a subject of taxation or as a measure of taxation, conveying rather the idea of gain or increase arising from corporate activities, as was said in Stratton Independence versus Halbert. So that goes on. I'm not going to read the whole book here. Stratton Independence, try to cover the highlights, but in Stratton Independence versus Halbert, as has been repeatedly remarked, the Corporation Tax Act of 1909 was not intended to be, and is not in any proper sense, an income tax law. This court has decided in the Pollock case that the income tax law of 1894 amounted to, in effect, a direct tax upon property was invalid because not apportioned according to the population as prescribed by the Constitution. The Act of 1909 avoided this difficulty by imposing not an income tax, but an excise tax upon the conduct of business in a corporate capacity, measuring, however, the amount of tax by the income of the corporation. Now, this is something I should point out here. A lot of folks say that the income tax only applies to corporations, and they use this case as a site. It happened in this particular act that was the activity that was privileged, that was the subject of that particular tax. But if there was some other activity that an individual was engaged in and was made the subject of a tax, the activity was a privilege and not something he had by right to do, then they've already decided that they can tax those activities. So it's not just limited to corporations, as this case was talking about corporations. They weren't saying it only applied to corporations. Here's another case. I guess it's Bowers versus Kerbaugh. Income has been taken to mean the same thing as used in the corporation excise tax of 1909 and in the 16th Amendment and in the various revenue acts subsequently passed. More cases. As repeatedly pointed out by this court, this is U.S. versus Witteridge. The Corporation Tax Act law of 1909, enacted as it was after Congress had proposed to the legislatures of the several states the adoption of the 16th Amendment, but before the ratification of that amendment, opposed an excise or privilege tax, not in any sense a tax on property or upon income, merely as income. All right? Grisher versus Union Pacific, 1916. The conclusion reached in the Pollock case recognized the fact that taxation on income was in its nature an excise. So taxation, see, this is where they get us confused and people start thinking. It's not the income. Taxation on income, taxation regarding income, or income used as the measure of the taxation. It's still referenced plenty of times to say that the taxation on privileges or exercises of privileges or franchises is an activity that can be taxed, and that income is the measure of the tax. In Slaper versus U.S., income within the meaning of the 16th Amendment and the Revenue Acts means gain. And in such connection, gain means profit. Proceeding from property, severed from capital, however invested or employed, coming in. So if you go there and you say, well, I got $50,000 this year in remuneration for my labor, and that's income. It's all profit, and your labor's worth nothing. So this is the mind thing. Now, I'm not saying that this is a thing to argue. I'm just saying this as reference for your understanding. If you go into court and you try to prove something, you're actually trying to disprove a negative, if you will. You go into court and say, well, that's what I got wasn't income. See, this wasn't gain, whatever. And you're putting the burden of proof on you. Burden of proof needs to be on the government on these kinds of things. So, and it goes on. There's more cases here. Again, it's chapter 2. It's just littered with quotes from the Supreme Court on the definition of income. The gain derived from capital, from labor, or from both combined, and on and on and on. So it's gain. Income is gain. So I think we'll skip over to chapter 3 now. And what is a taxpayer, and how does one become legally liable for an internal revenue tax? And so taxpayer is a term defined in the Internal Revenue Code, and for an internal revenue tax, most folks, or a lot of folks, think that the internal revenue is only dealing with the income tax. And I don't know what the number is, but I think it's over 40 different kind of taxes in the Internal Revenue Code. Gasoline, excise taxes are one, and taxes on wine and, imports and things like that. So again, the chapter starts off with what's actually being taxed. You want to keep asking, is this a tax on people, property, or activity? And no matter where you're paying that tax, you should ask yourself. Help your understanding on it. Now, in the definition of taxpayer in the Internal Revenue Code, it is a one-word term. If I go and I pay, say, property taxes, I'm a taxpayer, and that's 2 words. But in the Internal Revenue Code, it's a one-word term, taxpayer. And so taxpayer is a term defined in the Revenue Code, and it does not make any reference to the other taxpayer. So it's defined in Section 7701 of the Internal Revenue Code and Section 1313B And they define the term to mean any person subject to any internal revenue tax. And 1313 to mean any person subject to a tax under the applicable revenue law. The United States Court of Appeals for the Fifth Circuit tells us this. We see no distinction between the phrases liable for such tax and subject to such tax. So from now on, please train your mind to the difference between taxpayer or taxpayer. All right. So if you look through the Internal Revenue Code, and another interesting twist here is, you know, how did you become liable for a tax? Well, maybe I'm jumping around a little bit, but most of us were never told by the United States of America that you had to pay an income tax. Most of us told the United States of America that we had to pay an income tax. We filled out one of their forms, and we said, here is a form, and it says how many exemptions, etc. And you put down your taxpayer, you sign the form as a taxpayer. So you're telling the United States government that you're a taxpayer and you owe taxes on whatever they say you do by their rules and regulations. But they didn't come out and tell you that. Now, yeah, your employer might have said that to you. Before you can come to work here, you got to do this, that, and the other thing. But so if you look through the Internal Revenue Code, there's plenty of places where taxes are imposed. There's one here, gas guzzler tax. There's one, imposition on distilled spirits. There's another one on imposition and rates of tax on wines, and it also says who's liable for these things. As all these taxes are imposed, it goes on down to saying who's liable for the tax. And the collection of taxes on wines, it is persons liable for payment on wines. The taxes on wines provided in this subpart shall be paid in the case of wines removed from a bonded wine cellar by the proprietor. So it says who's liable for the tax there. And it goes through that on all these impositions. There's one here on estate and gift taxes. It says who's liable for that. There's one here on luxury passenger automobiles, and it says who's liable for that. There's one here on, what's this one, 4001? Yeah, that's the luxury passenger automobile tax. There's one here on wagering, and it says who's liable for that. Person's liable for the tax. Tax imposed on the income tax, it's laid out this way. Married individuals filing joint returns and surviving spouses. There is hereby imposed on the taxable income of. See, and this is where you start to get into the mind thing. Taxable income of. Well, we know that income can be the measure of a tax. It can be the subject of a tax. If it's the subject of a tax, it's a direct tax, and it has to be apportioned. Well, we don't have that happening with this so-called income tax out there. So they say there is hereby imposed on the taxable income of. Well, the question is, do you have taxable income? The question is, do you have income? And do you have taxable income? And what makes if you don't have income, you don't have gain, then, according to the Supreme Court, but if you did have gain and had income, then some of that's what they call taxable income. But if you didn't have gain, you know, et cetera, et cetera. So, and it goes on there, but it doesn't say who's liable. It just says there's hereby imposed on the taxable income of. And it goes on down with that. So this is interesting to know. If you ask the IRS, I mean, we should be able to ask the IRS, where is the tax imposed on me? Where am I made liable? Okay, take a break. We'll see you in Chapter 3 or Part 3.